This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. We get a chance to visit today with a brilliant leader and operator, and we're going to talk today leadership with Jim Feinstein. So we'll walk through several questions with Jim about leadership. Jim, let me ask you to take a second. Let me just start right from the get-go, and I'll ask you to introduce yourself as part of this. But you have led and built several different organizations through multiple different cycles. You've worked a lot in the healthcare private equity space and the physician practice space. Give us a couple leadership lessons that have stayed true for you, that you think about, that sort of you think about across good markets, tough markets. What are a couple of the core leadership lessons you'd share with our audience?
Sure. Well, first and foremost, thanks for having me, Scott. Always appreciate the opportunity. I think, through, good, bad cycles, one of the pillars that has been constant is practicing empathy. And I think coupled with operational discipline, an empathetic leader or leadership team typically makes decisions for the right reasons, which helps create a positive culture. And I also believe the operational discipline stemming from the successful delegate and leverage model allows or breeds teams that hold themselves accountable, at the same time feel a sense of ownership. And so I feel, regardless of the micro or macroeconomic environments, those pillars of leadership have proven to be successful regardless of the climate in the business environment.
Thank you. I love that concept, this discipline plus empathy, getting things done plus treating people well, sort of execution, competence, and empathy. I just love that take on it. Let me ask you another question. You've seen companies scale. You've worked a lot in the physician practice business, but growing large practices, private equity funded. When you look at companies that have scaled well, are there common denominators that you see culturally, operationally, that separate them from companies that end up getting stagnant or that plateau?
I think in the physician practice management space, choosing the right partner, and what I mean by that is the entrepreneurial physician, in my experience, has a tendency to be a more successful relationship, who has a tendency to understand, trust, and support the strategy and the model within the PPMC space, versus maybe physicians who are looking for a more traditional succession or transition plan versus a strategic partner, albeit both salient points are important within the healthcare ecosystem. I just feel that the scalable, successful relationship starts with the entrepreneurial physician, which typically has a culture and a practice with a wider and broader depth and breadth of ancillary services, and typically stays on the cutting edge of technology, modalities, and infrastructure investments that others may have ignored or placed on the wayside.
But you do need, in these growing practices, someone with great drive and fierce leadership, that entrepreneurial physician, an entrepreneurial dyad leader. Talk about that for a second, because that does seem a critical point in organizations that actually grow and keep going versus stagnate.
No, absolutely. And I think that entrepreneurial physician will remain engaged when they bring on a corporate partner. And I think with the right relationship, the PPMC model works really well when the corporate partner becomes more of a management consulting relationship that is going to execute on that blueprint for growth, and that operating partner where the physician typically knows the practice, the market better than the partner will, but doesn't have the time necessarily, the resources to execute. So to become successful in scaling And in executing that vision, I think it's really a collaboration between the vision of the founder and having a diverse, talented team to help support that growth strategy.
Thank you. And Jim, talk a little bit about, you work really close with this whole mix of physicians, executive leaders, and investors. What have you learned about, what can you share with us about balancing all those stakeholders while still pushing the business forward? How do you balance the needs of the investors versus the physicians? We hear so much about deals that don't go as they should, where the investors and physicians get sideways. How do you avoid that? How do you keep things moving forward in the right way?
Yeah, it's a challenge, that's for sure. I think partly is paying the right price for the right practice. Oftentimes, any relationship starts with an overpayment or paying a significant premium for a practice. You know, you have a tendency from a corporate or investor perspective to be chasing. You're digging yourself out of the hole, out of the gate. Therefore, I think the diligence and the valuation process is so important that sometimes walking away from a good deal becomes a better deal because it just doesn't fit the economic model from an IRR or an ROI perspective. So I think that choosing the right partner, paying the right price, and treating cash as king will help manage the investor's relationship. Aside from erring on the side of over communicating and over preparation, I think the investors appreciate, at least the half dozen of private equity partners that I've had over the past 3 decades, appreciate proactive communication when it comes to potential lurking landmines or surprises. Nobody likes surprises, especially private equity investors. And I think I pride myself on my transparency, candor, and ability to communicate effectively and proactively. And so that takes care of the investors to a certain extent. Obviously, good performance trumps any and all communications. The bottom line and the P&L speaks for itself. But then when it comes to physicians, I think what we found over the years, physicians are very smart individuals, generally speaking, and they like to make decisions that are data-driven. So instead of wasting anyone's time having discussions or negotiations that may be somewhat qualitative and quantitative, I found that leading discussions, opportunities with data makes the process go much smoother. And I think the physicians have a lot more respect for a team and or leader that come prepared with data to help drive the mission and or the agenda.
Thank you. And talk about the pricing issue on the front end, because what happens is when a PE fund or a sponsor or sponsored company gets overexcited and ahead of their skis, and of course they're doing this often in a competitive bid environment, then they end up sometimes overpaying. And when they overpay, you end up with higher amounts of debt on sometimes businesses that are not high margin businesses. And you end up, again, always trying to play catch up. Talk about how is there any way to manage that other than just walking away, particularly in a time when the markets are very frothy? How do you manage that competing challenge of wanting to get a deal done with not wanting to get yourself in trouble from a longer-term margin debt perspective?
Yeah, I think making those mistakes early in my career has taught me that, again, some of the best deals are the deals you just walk away from because they're too expensive. We've seen across multiple subspecialties, whether it's ophthalmology, dermatology, otolaryngology, a lot of failed processes over the last 24 to 36 months because of debt service. And that's a byproduct of overpayment as one of the key variables in that equation, in my opinion. And I think that it's really becomes a function of the initial thesis when entering this business is how do you grow these businesses? If you're overpaying for these assets and they're remaining stagnant or they're not showing growth required to drive down the multiple that you paid, then perhaps you didn't really take a look at, is the practice uh, able to add services, add providers, add patients, or improve margins. And if you can't check one or more than those boxes, then it's going to make that growth strategy significantly more difficult. And I'm not in the distressed asset business. I've been there before, but cutting costs to generate profits is a strategy that some embark upon, but you're not going to cut costs to growth. And we pride ourselves on our ability to grow these practices double digits, every year post-close. And that's a function of the aforementioned, identifying the right practices that A, have the physical plants to grow, B, are in markets that are attractive to recruit talent, because I think that's one of the biggest challenges healthcare is facing now, is how successful can you recruit the heir apparent and the new physicians to join these practices that are only going to become more and more difficult in less attractive secondary, tertiary, rural markets.
And this is so important, isn't it? Because if you can't add physicians, and you've had this whole trend over the last generation of every physician and his or her spouse moving to the biggest 25 metro markets, and you have these great successful practices in non-metro markets, but the trick is, can you recruit the next generation into those non-metro markets, even though you had somebody who just hit it out of the park in those non-metro markets for a long time? It's a really hard recruitment, isn't it?
It's virtually impossible. We're seeing significant signing bonuses, compensation packages with first, second year guarantees that are reaching seven figures, and still an inability to recruit into those marketplaces. I think given the supply and demand, the shrinking number of residency programs and fellowships, they have the opportunity to choose where they want to practice. And it's, to your point, the top 25 are a lot more attractive. People want to practice in the Chicagos, Atlantas, New Yorks versus the Little Rocks, with all due respect to the Little Rocks or Fargo, North Dakotas. And I think coming back to your previous question, choosing assets in the markets where recruiting will not be an issue is going to be ever so more important moving forward, because I think there's a real problem that our not necessarily children, but grandchildren and their children are going to experience. I have a hard time imagining them being successful in receiving healthcare and certain services in certain markets because of the supply and demand imbalance.
I mean, we're already seeing that now, where to get a specialist of the right type, the bench is shallow. You need to know somebody. I mean, it's already challenging in some of the metro markets. It's virtually impossible in some of the non-metro markets, and I think it's going to get a lot worse. I can't even imagine, not just our grandchildren, but our generation and the next generation, let alone it's got to be fixed by some point in the future, because supply and demand is really getting out of whack and getting there quickly. I think so many points are so right on, Jim. A couple more questions. One trend in healthcare or business that you think is underrated right now, and one you think is overstated. Is there a trend that you think is underrated that people don't talk about enough? And I think you might have touched on it here. And is there something that you think is overstated or overrated? Any thoughts there?
Yeah, well, I think we touched on the recruitment. I don't know if it's fair to say it's underrated, but having internal and external resources with lines in the water at all times is going to continue to be ever so important. I think what might be overstated, and I don't want this may come across controversial, but I think to a certain extent, the term value-based care. A lot of debate, a lot of discussion about how it continues to evolve. I don't want to take anything away from the importance of, clinical service and quality assurance and quality measures. But I think given the hospitals and health systems' ability to self-select services, site of service, the payers and relationship in the aforementioned, I think the focus and attention on value-based care is, I think, losing momentum and falls into that overstatement category for me, just because living in the private practice environment for 30 plus years, we've witnessed and we experience the importance of an affiliated relationship with the hospitals. At the same time, we understand the competitive DNA with employed physicians versus affiliated physicians and how the PCP networks are controlled and patient steerage can be driven to certain sites of services and, in-network, out-of-network payer strategies. So I think we definitely need to continue on quality measures, but I don't know if the whole VBC train is on the right track.
100%. I mean, it certainly seems like the value-based care became a talking point and a payer point and a Medicare Advantage point and a capitated point, but not really a real value point. I mean, it seems like I think if you talk to a fee-for-service physician who's doing something for pay and trying to get paid for it and doing it well, they think just as much they're giving value-based care as somebody who's getting a capitated fee or some other kind of fee and trying to pretend to manage care in some way or another too. I could not agree with that take on it more. I love that. Sorry, Jim, and I don't mean to offend those people in the value-based care world. But I think it's an insult to those that are doing fee-for-service medicine that believe they're actually giving value for care.
Absolutely.
In any event, Jim Feinstein with us today on the Becker Private Equity and Business Podcast, one of the great leaders of our time in the practice management world, just a fantastic thinker and leader and executor. Jim, thank you so much for taking the time to visit with us today. I really enjoyed it. As always, thank you so much.
Much appreciated. Thank you, Scott.